My uncle called my investment portfolio play money at my graduation party. Then he checked the numbers and sat frozen for 90 minutes. The champagne glass in my uncle's hand stopped halfway to his mouth, and I watched the color drain from his face in real time. He'd been scrolling through my phone for maybe 3 minutes, his expression shifting from smug condescension to confusion to something I couldn't quite identify yet. His wife Diane touched his arm, asking if he was all right, but he didn't respond, just kept staring at the screen like it had personally betrayed him. The backyard party continued around us, 60 people celebrating my college graduation, completely unaware that my Uncle Raymond had just discovered that everything he'd believed about me for the past 6 years was catastrophically wrong. His hands started trembling slightly, enough that I worried he might drop my phone. The hedge fund manager who'd spent the last hour loudly explaining to anyone who'd listen why young people didn't understand real investing, why my hobby of buying stocks with birthday money was cute but meaningless, had just opened my Schwab account statement and seen numbers that apparently broke something in his brain. I'd been investing since I was 16, starting the summer before junior year of high school when my grandmother died and left me $8,000. Most kids would have bought a car or saved it for college. I'd opened a brokerage account with my dad's help and started reading everything I could find about value investing, growth strategies, and market analysis. That first year, I turned $8,000 into $12,000 by identifying 3 undervalued tech companies before they announced major contracts. I'd gotten lucky on timing, sure, but I'd also done the research, read the SEC filings, understood the products. By the time I graduated high school, my portfolio was worth $32,000. I'd paid my own way through state college by continuing to invest strategically, identifying opportunities in sectors I understood, taking calculated risks that paid off more often than they didn't. I'd worked part-time jobs too, but most of my college funding came from investment returns. And I'd kept it quiet, because I'd learned early that talking about money made people uncomfortable, and talking about success made them assume you were lying or arrogant. Uncle Raymond was my father's older brother, 53 years old and managing director at Castellan Capital, a mid-sized hedge fund in Chicago that managed about $800 million in assets. He'd gone to Wharton for his MBA, had 30 years of experience in finance, and never let anyone forget either of those facts. He was the family success story, the one who'd made it big, who drove a Tesla Model S and owned a vacation home in Scottsdale and sent his kids to private schools. Every family gathering became an opportunity for Raymond to hold court, dispensing financial wisdom and making sure everyone knew he was the smartest person in the room. My own father worked in sales, made decent money but nothing spectacular, and had always seemed slightly diminished in Raymond's presence, like he was the kid brother who'd never quite measured up. I'd watched this dynamic play out my entire life, Raymond's subtle condescension dressed up as brotherly concern, and I'd learned to stay quiet and avoid becoming a target for his expertise. But 6 months ago, I'd made a mistake. I'd mentioned at a family dinner that I'd been doing some investing, that I'd managed to cover most of my college expenses through returns on a portfolio I'd built. Raymond had laughed, actually laughed, and said something about how cute it was that I was learning about the stock market with my allowance money. When I'd tried to explain that I'd been doing this for years, that my portfolio had grown substantially, he'd waved me off. Everyone thinks they're Warren Buffett in a bull market, kid. Wait until you experience a real correction and watch your play money disappear. Then you'll understand why professionals like me exist. The rest of the family had nodded along, accepting his assessment because Raymond was the expert, and I was just a college kid who probably didn't know what I was talking about. My father had given me a sympathetic look that somehow made it worse, like he felt bad that I was being publicly dismissed, but also agreed that Raymond was probably right. That conversation had planted something in me, a quiet anger that I'd carried for months. Not because Raymond had been condescending, that was just his nature, but because my own family had so readily accepted his judgment without ever asking me for specifics. They'd assumed I was exaggerating or deluded, that a 22-year-old couldn't possibly have built something significant in the financial markets without professional training or family wealth. So when my graduation party arrived in May, when Raymond started holding court again about the markets and investment strategy, I'd felt that anger resurface. He'd been drinking gin and tonics in my parents' backyard, surrounded by relatives and family friends, explaining why retail investors were essentially gambling and how real wealth building required institutional knowledge and resources. Then he'd turned to me with that smile I'd learned to hate, the one that pretended to be avuncular but carried contempt underneath. "You still playing with your stock portfolio, Danny?" he'd asked, loud enough for nearby conversations to pause. "How's that working out for you in this market?" The question was designed to embarrass me, to prove his earlier point about amateurs losing money when markets got volatile. The S&P had dropped about 8% over the past 2 months on inflation concerns, and Raymond clearly expected me to admit I'd taken losses. I'd looked at him calmly and said, "Actually, I'm up about 18% year to date. Portfolio's performing pretty well." Raymond's expression had shifted to something between amusement and pity. 18%? Danny, that's not how you calculate returns. You can't just cherry-pick good positions and ignore the losers. What's your actual portfolio performance? I'd pulled out my phone and opened my Schwab app. Want to see the statements? And that's when Raymond had made his fatal mistake. He'd reached for my phone with supreme confidence, ready to educate me about reading financial documents properly, ready to show everyone assembled why my claims were inflated or misunderstood. Let's take a look at this play money portfolio, and I'll explain what the numbers actually mean. Now he was standing frozen, my phone in his trembling hands, staring at an account summary that showed a total portfolio value of $438,612 and change, year-to-date returns of 18.3%, 5-year annualized returns of 26.7%, holdings across 43 positions in individual stocks, sector ETFs, and a few carefully selected option strategies. Every number documented, verified, real. I watched him scroll through the positions, seeing the familiar names. Microsoft, bought at $92, now trading at $340. Tesla, purchased at $48 pre-split, now worth 10 times that. Nvidia, bought at $36, now at $215. He was seeing the same screens I checked every morning, the same portfolio I'd built over 6 years through research and discipline and calculated risk-taking. And his brain was apparently struggling to process how someone my age, without professional training or family wealth or institutional resources, could have built something this substantial. Diane was asking him again what was wrong, her voice carrying concern now. Other relatives were starting to notice Raymond's frozen state, conversations trailing off as people turned to see what was happening. My father approached, asking if everything was okay. Raymond didn't respond to any of them, just kept scrolling through my positions, his jaw working like he was trying to form words, but couldn't quite manage it. I felt a mixture of vindication and discomfort watching this play out. I'd wanted him to see the numbers, wanted him to confront how wrong he'd been about dismissing my work. But I hadn't anticipated this level of shock, this complete system failure in someone who prided himself on never being surprised by markets or money. My mother appeared at my elbow, whispering, "Danny, what's going on? What did you show him?" I told her quietly that Raymond had asked to see my investment portfolio, and I'd let him. Her eyes widened because she had known for a while actually, that my investments had done well. But she'd also respected my desire to keep it private, to not make it a thing at family gatherings. Raymond finally spoke, his voice strange and tight. "Where did you get this money?" The question came out almost accusatory, like he was trying to find an explanation that made sense to him. Money laundering, inheritance I hadn't mentioned, fraud of some kind, anything except the obvious truth that I'd built this through investing skill. I felt anger flash through me at the implication. "I started with $8,000 from Grandma's estate. Everything else is returns on investment over 6 years. Raymond shook his head, still scrolling. "That's not possible. You can't turn $8,000 into $400,000 in 6 years without taking massive risk or getting incredibly lucky." I let the statement hang there for a moment before responding. I did both, actually. I took calculated risks on companies I'd researched thoroughly. And yes, I got lucky on timing sometimes. But I also did the work, Raymond. I read annual reports and SEC filings. I analyzed market trends and competitive positioning. I built diversified positions and managed risk through position sizing. Everything you'd do professionally, I did independently. His face was red now, that color that suggested either embarrassment or anger or both. "You're 22 years old. You don't have the experience or training to generate these kinds of returns consistently." My father intervened, his voice careful. "Raymond, maybe we should discuss this somewhere private?" But Raymond wasn't listening. He was locked into some internal crisis where his professional identity and his view of family hierarchy were colliding with evidence that contradicted both. "Danny, these returns aren't sustainable. You've been lucky in a bull market, but when correction comes..." I cut him off, my own anger breaking through the careful politeness I'd maintained. "When correction comes, I'll adjust my positions like I did in March 2020 when COVID tanked the market. I went heavily into tech and biotech companies positioned to benefit from lockdown and remote work. That's when I bought Zoom at $90 and sold at $400. That's when I bought Moderna before the vaccine announcement. Not luck, Raymond. Research and timing." The backyard had gone completely quiet now. 60 people watching this confrontation unfold, sensing something significant was happening even if they didn't understand the specifics. Diane took Raymond's arm more firmly. "Honey, maybe we should sit down." But Raymond pulled away from her, still gripping my phone like it was evidence in a trial. "I want to see the transaction history. Anyone can Photoshop an account summary." The accusation stung more than I expected because it revealed how desperately he needed this not to be true. I took my phone back from him, my hands steady, despite the adrenaline coursing through me. "Fine. Here's my transaction history going back 6 years. Every buy, every sell, every dividend payment. All documented through Schwab's system. You want to see my tax returns too? I've been paying capital gains taxes since I was 17. I pulled up the transaction log and handed the phone back. Raymond took it with mechanical movements, his executive function apparently reduced to basic motor skills, while his higher cognition tried to process this information. He scrolled through hundreds of transactions, seeing the pattern of my strategy laid out in data. Small positions in companies I believed in, held for months or years until they appreciated. Occasional options trades that had paid off. Careful diversification across sectors. Nothing flashy or reckless, just consistent execution of value investing principles I'd learned from reading Graham and Lynch and Buffett. My cousin Lisa, Raymond's daughter who was my age and worked at a consulting firm, spoke up from the crowd. "Dad, is Danny's portfolio really worth almost $500,000? Her voice carried disbelief and something else. Maybe resentment that her father's expertise was being challenged by someone our age. Raymond didn't answer her. He'd stopped scrolling and was just staring at one particular transaction, a purchase of GameStop stock in September 2020 at $4 a share that I'd sold in January 2021 at $320. A 70-time return that had added over $100,000 to my portfolio in 4 months. You bought GameStop before the squeeze? His voice was hollow, almost awed despite himself. I nodded. I'd been following the short interest data and saw the setup forming. I put $5,000 into shares and options, sold on the way up and got out before the crash. Raymond's hand went to his forehead, pressing against his temple like he had a sudden headache. The GameStop squeeze had been one of the biggest market stories of the past few years, retail investors coordinating through social media to drive massive gains in heavily shorted stocks. Professional investors like Raymond had largely missed it or gotten caught on the wrong side. The fact that a college kid had identified and profited from it while hedge fund managers lost billions seemed to be the detail that finally broke through his defenses. He looked at me with an expression I'd never seen from him before, something raw and almost hurt. Why didn't you tell anyone you were doing this well? Why didn't you ask for advice or guidance? The question revealed so much about how he saw the world, the assumption that of course I would have needed his help, that my success couldn't possibly have happened independently. I did tell you, Raymond. 6 months ago at dinner. You laughed and called it play money. You said I'd lose everything in a correction. You dismissed me without asking a single question about my strategy or my positions. My voice was level but hard, each word landing with precision. I didn't need your guidance because I'd already built something substantial on my own. And I didn't tell the family the full numbers because I knew how people would react. Either they wouldn't believe me, or they'd treat me differently, or they'd assume I'd gotten lucky and was about to lose it all. Easier to just keep it private and let the returns compound. My father was staring at me like he was seeing someone new. Danny, I had no idea the portfolio had grown this much. You said you were covering college expenses, but I thought you meant like books and rent, not everything. I met his eyes and saw confusion there, maybe some hurt that I hadn't shared this with him. I didn't want to make it a big thing, Dad. You and Mom taught me not to flash money around. And honestly, I was worried about exactly this kind of reaction. Everyone questioning how it was possible, assuming I was lying or had done something wrong. My mother moved closer, her hand on my shoulder protective, even though I was the one who'd caused this scene. You should have told us, honey. We're proud of what you've accomplished. We would have supported you. Maybe she was right. But 6 years of keeping this private had created its own momentum, its own reasons for continued secrecy. Raymond handed my phone back with hands that were still shaking slightly. He looked like he'd aged a decade in the past 10 minutes, the confident swagger he'd carried into this party completely deflated. I apologize, Danny. I was wrong to dismiss your work without understanding the scope of it. These returns are genuinely impressive, especially for someone your age. The apology should have felt satisfying, but instead, it just felt sad, watching someone I'd known my whole life confront the limits of his assumptions. You weren't completely wrong, Raymond. I have been lucky. The market has been favorable, and I've made some bets that could have gone badly but didn't. But I also did the work to put myself in position for that luck to matter. He nodded slowly, some of his composure returning. Can I ask what your strategy going forward is? Are you planning to pursue this professionally? It was the first genuine question he'd asked me about investing, devoid of condescension or assumption. I start at Vanguard in 3 weeks, junior analyst position in their equity research division, $48,000 salary to start, but the learning opportunity is what matters. I want to understand institutional investing, how professional portfolio management works at scale. Raymond's eyebrows rose. You're starting at Vanguard? I nodded. I applied through their campus recruiting program last fall, went through 5 rounds of interviews. They liked that I had practical investing experience, that I could discuss actual positions I'd managed and lessons I'd learned from mistakes. The GameStop trade got me in the door, but my performance on the case studies got me the offer. Lisa spoke up again, her voice sharp. Dad, you told me institutional investing jobs were impossible to get without an MBA and connections. Danny got a position at Vanguard straight out of undergrad? The comparison was implicit but brutal, highlighting that Raymond's daughter had followed his advice about career paths while I'd succeeded by ignoring it. Raymond looked at his daughter, then back at me, and I saw him calculating something. Danny, have you thought about whether you want to manage your own portfolio long-term or transition the assets to professional management? $400,000 is substantial, but it's not enough to justify the time and risk of active management if you're going to be working full-time. It was a reasonable question from a professional perspective, but I heard the subtext. Maybe you've gotten lucky so far, but you should let experts handle it from here. I'd anticipated this suggestion and had my answer ready. I'm keeping most of it actively managed by me, at least for now. I've outperformed the S&P by an average of 14% annually over 6 years. I understand that's unlikely to continue forever, but I also know my strategy and my risk tolerance better than any advisor would. I am moving $100,000 into index funds as a stability position, but the rest stays under my active management. Raymond started to respond, probably with reasons why that was a mistake, but stopped himself. He was learning, slowly, that maybe he didn't know better than me in this specific domain. That's a mature approach to risk management. The index fund position provides downside protection while you continue active trading with the rest. He was trying to reclaim some advisory role, to contribute something to the conversation, even if it was just affirming a decision I'd already made. The party had started to fracture, small groups of relatives processing what they'd witnessed and forming their own conversations about it. I could hear fragments of discussion, people questioning how much of what they'd heard was true, others pulling out phones presumably to Google Vanguard or look up stock prices I'd mentioned. My Aunt Teresa approached with her husband Kevin, both looking at me with new interest. "Danny, I wish we'd known you were doing so well with investing. Kevin and I have been trying to figure out what to do with his retirement fund, and we're getting conflicting advice from advisors." She was treating me like an expert suddenly, like someone whose opinion mattered on financial topics. It was jarring after years of being the kid who didn't understand how the real world worked. "I can share some resources about passive index investing for retirement accounts," I offered carefully. "But my expertise is more in active stock picking for growth. Retirement investing requires different strategies, more conservative allocations," Kevin pressed. "But you've clearly figured out something that works. Those returns you mentioned, 26% annualized, that's incredible." I tried to modulate his expectations. That's not repeatable at scale, and it required significant risk tolerance. I was investing money I could afford to lose completely, which let me take positions in volatile growth stocks. Retirement money needs more stability. But Kevin was already pulling out his phone, wanting me to look at his portfolio allocation and give opinions. This was what I'd feared about disclosure, suddenly becoming the family investment advisor, everyone wanting a piece of whatever magic they thought I'd discovered. My father rescued me, suggesting that maybe detailed financial discussions could happen later and we should let the party continue. People gradually drifted back to food and conversations, though I noticed many kept glancing my way, reassessing who I was in light of this new information. Raymond had moved to a chair near the pool, sitting down heavily with Diane beside him, speaking to him in low, urgent tones. I couldn't hear what she was saying, but her body language suggested she was either comforting him or scolding him, possibly both. Lisa had disappeared inside the house, presumably processing her own complicated feelings about this revelation. My younger sister Kara, who was 17 and had been watching the whole confrontation with wide eyes, came over and hugged me. That was the most badass thing I've ever seen. Uncle Raymond looked like he'd been hit by a truck. I hugged her back, appreciating her uncomplicated support. I didn't mean for it to be a scene. I just got tired of him dismissing me. Kara pulled back, grinning. "No, that needed to happen. He's been so condescending to everyone for years, acting like he's the only person who understands money. Watching him realize you've been quietly kicking his ass in returns for 6 years was beautiful." She had a point. Raymond's Castellan Capital Fund had averaged about 11% returns over the past 5 years, according to their public disclosures. Solid, but not spectacular. My 26% annualized returns had more than doubled his professional performance, which had to sting for someone whose identity was wrapped up in being the family financial expert. The difference is, he's managing $800 million in institutional money with different constraints and requirements. My portfolio is tiny by professional standards. Comparing them directly isn't really fair. Kara shrugged. "Maybe, but he's the one who made it a comparison by calling your work play money. He set up the dynamic and then got proven wrong. That's on him." She was right about that too. Raymond had created this confrontation through years of dismissive comments, and today I'd finally stopped letting it slide. The rest of the graduation party continued in strange, fractured fashion. Some people tried to act like nothing had happened, making determinedly normal conversation about my plans and my degree in economics. Others kept circling back to investment topics, asking questions about specific stocks or market trends, treating me like someone whose opinion suddenly had value. I found myself giving impromptu explanations of my investment philosophy, the value of long-term holding periods and diversification, the importance of only investing in companies you understood. It was exhausting in ways I hadn't anticipated, performing expertise for an audience that had ignored me for years. Around 8 p.m., as the party was winding down and people were saying goodbyes, Raymond approached me alone. Diane had taken their kids to the car, giving him space for whatever conversation he wanted to have. He looked tired, the earlier shock replaced by something more complex. "Danny, I want to apologize more thoroughly, not just for today, but for years of not taking you seriously. I made assumptions about your capability based on your age and my own arrogance, and those assumptions were wrong." The apology felt genuine this time, stripped of the defensive posturing from earlier. I nodded acknowledgement. "I appreciate that, and I'm sorry I let it build up to a public confrontation. I could have handled this more privately." Raymond shook his head. "No, I needed the public element to actually hear it. If you'd shown me privately, I probably would have found ways to dismiss it or minimize it. Having witnesses made that impossible." He paused, seeming to struggle with what to say next. "Can I ask for some advice? Professional to professional?" The phrasing made me uncomfortable because I didn't feel like a professional despite my returns. "I'm not sure I'm qualified to give you advice, Raymond. You have 30 years of experience in institutional finance." He smiled tightly. And you have 6 years of experience generating better returns than most professionals manage. That counts for something. Here's my question. I've been feeling increasingly constrained by institutional investing requirements. Compliance, client restrictions, committee approvals for every position. What you're doing, individual active management, represents a freedom I gave up decades ago. Do you think there's value in someone my age transitioning back to managing their own wealth more actively? It was a vulnerable question, revealing doubts about his career path I doubted he'd shared widely. I considered how to answer honestly without being harsh. I think it depends on what you value. Institutional investing provides stability, reputation, resources. Individual management provides freedom, flexibility, direct accountability for results. But transitioning would mean giving up a lot of what you've built professionally. Raymond nodded slowly. That's what I'm wrestling with. Castellan is stable, but the returns have been mediocre lately. We're missing opportunities because we can't move fast enough or take positions that don't fit our stated strategy. Meanwhile, retail investors are identifying trends before we can get committee approval to research them. It's frustrating. I could hear the career crisis forming in his words, the realization that maybe the path he'd chosen had trade-offs he hadn't fully considered. Have you thought about starting your own fund? Smaller, more agile, where you have direct control? I suggested. Raymond's expression shifted to something like surprise. That's actually not a bad idea. I have enough of a track record to attract some capital. Could structure it to allow the kind of active management I'm missing at Castellan. He looked at me with what might have been respect. When did you get so insightful about career strategy? I shrugged. I've spent 6 years thinking about markets and positioning and risk management. Some of that applies to careers too. You're facing a strategic choice about where your competitive advantage is strongest and what structure lets you deploy it most effectively. Raymond laughed, but it sounded more genuine than any laugh I'd heard from him before. I just got business strategy advice from my nephew at his graduation party. My therapist is going to love this story. The admission that he saw a therapist humanized him in ways I hadn't expected. We talked for another 20 minutes, the conversation shifting to actual technical discussion of market conditions and investment theses. Raymond asked detailed questions about my GameStop trade, my process for identifying the setup, how I'd manage the exit. I walked him through my analysis of short interest data, social media sentiment, and technical patterns. He listened without interrupting, occasionally nodding or asking clarifying questions. It was the conversation we could have been having for years if he'd ever bothered to ask. When he finally left, he shook my hand firmly. I meant what I said about being wrong, and I want to continue these conversations if you're willing. I think I might actually learn something. I told him I was willing, meaning it despite the complicated history. After everyone left, I helped my parents clean up the backyard while they processed what had happened. My father was quiet, which usually meant he was working through something complicated emotionally. Finally, he spoke. I wish you'd told me how well you were doing, Danny. I'm your father. I should have known. The hurt in his voice made me feel guilty, despite having valid reasons for privacy. I'm sorry, Dad. I wasn't trying to shut you out. I just didn't want money to change how our family worked. And I was worried about reactions like Raymond's, people assuming I was lying or had gotten lucky in ways I didn't deserve. My father set down the trash bag he'd been filling. Do you think I would have reacted like Raymond? Do you think I would have dismissed you? The question hung in the night air, heavy with implications. I thought about how to answer honestly. I don't know. Maybe not dismissed exactly, but you've always deferred to Raymond on financial stuff. You've treated him like the expert in the family. If I'd told you 6 years ago that I was going to beat his professional returns by actively managing stocks, would you have believed me? My father was quiet for a long moment. Probably not, he admitted. I probably would have worried you were taking too much risk or getting in over your head. I would have suggested you talk to Raymond about proper investing strategies. He looked at me with sad eyes. I'm sorry I made you feel like you couldn't share this part of your life with me. That's on me, not you. The apology felt bigger than this specific situation, encompassing years of subtle dynamics where Raymond's expertise had overshadowed other family members' capabilities. My mother had been listening from nearby, and she joined our conversation. What happens now, Danny? You've got this substantial portfolio, and you're starting a professional job. How does that change things? I'd been thinking about that exact question. Honestly, I'm not sure. The money gives me freedom and security I didn't have before, but I don't want it to define me or change how I relate to people. That's why I kept it quiet for so long. My mother hugged me, fiercely protective. You've earned this success through work and intelligence. Don't let anyone, including your uncle, make you feel like you need to hide it or apologize for it. But also, don't let it become the only thing people see when they look at you. The advice felt wise, balancing pride and caution in ways that made sense. The next few weeks brought unexpected ripple effects from the graduation party confrontation. Word spread through the extended family network about my portfolio and Raymond's reaction, each retelling probably embellishing details. I got calls and messages from relatives I barely knew, some congratulating me, others wanting investment advice, a few suggesting they'd always known I was smart with money, even though they'd never mentioned it before. The revisionist history was predictable, but still annoying. More significantly, my relationship with Raymond shifted in fundamental ways. He started calling me weekly, initially to ask questions about specific investment ideas, but gradually expanding to broader conversations about markets and career strategy. I learned that his crisis at the party had triggered deeper reflection about his professional trajectory and his identity beyond being the family financial expert. He ended up leaving Castellan Capital 6 months after my graduation to start his own boutique investment fund with 3 partners, raising $30 million in initial capital from former clients and colleagues. The new fund, Meridian Partners, allowed Raymond the flexibility he'd been craving, and I watched him become more energized about work than he'd seemed in years. He credited our conversation at the graduation party with helping him recognize what he actually wanted from his career. You asking whether there was value in transitioning back to active individual management made me realize I'd stopped managing anything actively. I'd become an administrator, focused on client relations and compliance rather than actual investing. That's not why I got into this business. He'd found his way back to what he loved, which made me genuinely happy for him despite our complicated history. Lisa, his daughter, had a harder time processing everything. She called me about a month after the party, her voice tight with emotions she was trying to control. I need to understand something, Danny. My father spent my whole life telling me that success in finance required specific credentials and pathways. MBA from top schools, analyst programs at major firms, networking with the right people. You ignored all that advice and succeeded anyway. How am I supposed to feel about that? The question revealed hurt I hadn't fully considered, how my success had inadvertently undermined advice Raymond had given his own children. I got lucky, Lisa. The timing of my start, the bull market conditions, some positions that could have gone very differently. The path I took isn't replicable or advisable for most people. But Lisa wasn't accepting that deflection. Stop minimizing what you did. You identified a strategy, executed it consistently, and generated exceptional returns. That's skill, not just luck. Meanwhile, I followed my father's advice, got my consulting job through connections he provided, and I'm doing fine, but not exceptional. I'm realizing his advice was based on his own path, not necessarily the best path. Her voice cracked slightly. And he's calling you now for advice. His nephew. I'm his daughter, and he never asked my opinion on his career decisions, but you have one conversation, and suddenly he's restructuring his professional life. I heard the pain underneath her words, the complicated mix of pride in her father and hurt at feeling overlooked. Raymond calling me doesn't mean he doesn't value you, Lisa. We have a specific shared interest in active investing strategy that created space for different conversations. That doesn't diminish your relationship with him or your own accomplishments. We talked for over an hour, Lisa processing her feelings about family dynamics and career paths and expectations. By the end, she was calmer, but still wrestling with fundamental questions about her own choices. I think I need to figure out what I actually want, instead of just following the path that was laid out for me. That's what you did, right? You found your own way, instead of following the expected route. I agreed that was approximately true, though it sounded more intentional than my actual experience had been. My start at Vanguard in June brought new challenges and perspective. Working as a junior analyst meant being the least experienced person in most rooms, subordinate to portfolio managers with decades of experience. The contrast between my individual investing success and my institutional inexperience was humbling in necessary ways. My manager, Gregory Sutton, a 28-year veteran of equity research, made it clear early that my personal returns were impressive, but didn't automatically translate to institutional competence. Individual investing rewards different skills than institutional portfolio management, he explained during my first week. You can take concentrated positions, move quickly, hold through volatility because you're only accountable to yourself. Here, you're accountable to clients, compliance, and fund objectives. The constraints are different, and the skill sets don't always overlap. It was the reality check I needed, a reminder that my success in one domain didn't make me an expert in all domains. I spent the first 6 months at Vanguard learning to operate within institutional frameworks, understanding how committee-based investment decisions worked, contributing to research reports that fed into larger portfolio strategies. It was frustrating sometimes, especially when I saw opportunities in individual stocks that our funds couldn't pursue due to size constraints or strategy mandates. But it was also educational in ways my independent investing never was. I learned about risk management at scale, about balancing thousands of client accounts with different objectives, about the regulatory and fiduciary requirements that governed professional management. Gregory became a mentor, helping me translate my individual investing instincts into institutional analysis skills. You have good market intuition, he told me during a 6-month review, but you need to develop the systematic research process that makes that intuition reproducible and defensible. Anyone can get lucky on a few trades. Professionals need to explain why their analysis should be trusted consistently. I took the feedback seriously, working to formalize the research methods I'd developed informally over 6 years of independent investing. I created detailed investment theses with supporting evidence for every position I recommended, learning to think probabilistically about outcomes rather than in binary right-wrong terms. My personal portfolio continued to perform well, up another 23% in my first year at Vanguard, despite being more conservative in position sizing as my responsibilities increased. But I kept it completely separate from my professional work. never mentioning my returns to colleagues or using my personal positions to inform institutional recommendations. The wall between personal and professional investing felt important to maintain both ethically and practically. Gregory knew about my background through my interview process, and he occasionally asked how I was thinking about specific stocks in my own portfolio, using those conversations as teaching moments about the difference between individual conviction and institutional analysis. By the time my one-year anniversary at Vanguard arrived, I'd learned enough about institutional investing to appreciate both its strengths and limitations. The resources available for research, the depth of analysis that went into every position, the risk management frameworks that prevented catastrophic losses, all of that was impressive and valuable. But I also understood why institutional funds often underperformed individual investors who could move quickly and take concentrated positions. The trade-offs were real and significant. Raymond and I continued our weekly calls, and our conversations evolved as I learned the institutional side of investing he'd lived with for decades. I could now understand his earlier frustrations with committee approvals and compliance constraints in ways I couldn't have as an independent investor. "You're getting the education I skipped," he told me during one call. "I went straight from MBA to hedge fund analyst to portfolio manager without ever managing my own money actively. Everything I learned was within institutional frameworks. You're doing it backwards, starting with personal investing and then learning institutional methods. I think your way produces better investors, actually." The compliment meant more than it would have a year earlier because it came from understanding rather than performance comparison. Raymond's own fund was performing well, up 19% in its first year against a benchmark of 12%. Not as spectacular as my personal returns, but exceptional for institutional management. And he attributed some of his success to thinking more like an individual investor with fiduciary responsibilities rather than an institutional manager trying to preserve his job. Talking with you weekly has reminded me why I got into this business. The intellectual challenge of finding undervalued companies and having the conviction to back that analysis with capital. I'd lost that somewhere in the bureaucracy of large fund management. His fund was growing, attracting additional capital from investors who appreciated the more active, concentrated strategy he'd adopted. The 2-year mark after my graduation party brought an unexpected opportunity. Gregory pulled me into his office and closed the door, which usually meant something significant was about to happen. "Danny, you've developed faster than any analyst I've mentored in 28 years. Your research is institutional quality, but you still have the individual investor's instinct for identifying opportunities before they're obvious. I've recommended you for early promotion to senior analyst, and the committee approved it. Comes with a raise to $78,000 and expanded responsibilities in our technology sector coverage. The promotion was earlier than typical, usually requiring 3 to 4 years rather than 2, and Gregory made clear it was based on performance. You've contributed analysis that directly improved our fund positioning in 3 major positions this year. Your work on semiconductor supply chain dynamics helped us avoid a position that would have cost the fund $40 million in losses. That's the kind of impact that gets noticed." I thanked him, genuinely grateful for the mentorship and the opportunity. But I also asked the question that had been forming over 2 years of institutional work. "Gregory, do you think there's a career path that combines institutional resources with more individual-style active management? Something between what I'm doing here and what I was doing independently?" He'd clearly been expecting the question. "You're asking whether you want to become a portfolio manager eventually, or whether you want to start your own fund like your uncle did?" I nodded. "I love the research and analysis we do here, but I miss the freedom to act on conviction, to make concentrated bets when analysis supports them. I'm wondering if that tension ever resolves, or if I need to choose one path or the other." Gregory leaned back in his chair, considering his response. "Most people do eventually choose. Some stay institutional and accept the constraints because they value the stability and resources. Others leave to start their own funds or return to individual management because they value the freedom. A few find hybrid roles, running concentrated strategies within larger institutional frameworks, but those positions are rare and competitive." He paused. "What I'll tell you is this. You're 24 years old with institutional experience, proven individual investing returns, and the intelligence to understand both worlds. You don't need to choose yet. Keep building skills, keep growing your personal portfolio as a laboratory for testing ideas, keep learning institutional methods. When you're 30, you'll have options most investors never get. Don't rush the decision." The advice resonated with me. Permission to not have everything figured out immediately. I continued at Vanguard, taking on the senior analyst responsibilities and expanding my coverage to include emerging technology companies. My personal portfolio crossed the $700,000 mark 2.5 years after the graduation party, growing through a combination of continued strong returns and aggressive savings from my Vanguard salary. I lived modestly, saving over half my income and investing it alongside my original capital. The compound growth was accelerating, each year's returns building on a larger base. I'd started modeling when the portfolio might hit $1 million, optimistically within another 18 months, conservatively within 3 years. The prospect of being a millionaire before turning 27 felt surreal even as the math supported it. Raymond's fund crossed $100 million in assets under management around the same time, solidifying Meridian Partners as a legitimate boutique investment firm. He'd hired 4 additional analysts and was considering opening a London office to expand internationally. His success had rehabilitated his professional reputation after the risk of leaving Castellan, and he credited our relationship with helping him find clarity about what kind of investor he wanted to be. I spent 25 years trying to be the biggest, managing the most assets, having the most impressive institutional credentials. You reminded me that what actually matters is generating good returns and enjoying the work. Everything else is ego. He'd become thoughtful about professional success in ways that made our conversations richer than pure investment analysis. My parents had adjusted to knowing about my financial success, though it still created occasional awkwardness. My father had started asking me questions about his retirement planning, which felt strange given our historical dynamic, but also represented his acceptance that maybe I knew what I was talking about. My mother worried about me working too hard, burning out from the combination of demanding job and active personal portfolio management. You're 24 years old, Danny. You should be enjoying life, not spending every evening analyzing stocks. I tried to explain that I did enjoy it, that the intellectual challenge was rewarding rather than burdensome. But I also recognized she had a point about balance. I'd built my entire early adult life around investing and professional development, sacrificing social connections and experiences for financial success. The trade-off had been worth it in many ways, but it wasn't sustainable long-term. Kara graduated high school around this time, and at her graduation party, she made a point of pulling me aside. I need your advice on something, and I don't want to hear the standard parental line about following my passion or whatever. I braced for whatever was coming. I want to do what you did. Start investing early, build a portfolio, maybe skip the traditional career path entirely. You've proven it's possible. So how do I start? The question made me uncomfortable because I knew how easily my path could have failed. Kara, I got lucky on timing and positions. What worked for me isn't a template anyone should follow blindly. But she was insistent. I'm not talking about copying your trades. I'm talking about the approach. Learning about investing early, taking it seriously, building skills that create financial freedom. Why shouldn't I try that? I spent 2 hours talking through the reality of what I'd done, the research required, the emotional discipline to hold through volatility, the risk of catastrophic losses that I'd managed to avoid but easily could have experienced. I walked her through my biggest mistakes, the positions that had lost money, the lessons learned from failed analysis. I wanted her to understand that success in investing required more than intelligence or luck. It required emotional regulation, continuous learning, and acceptance of uncertainty. By the end, Kara was still interested but more realistic about the challenges. Okay, so it's not a get-rich-quick scheme. It's a skill that takes years to develop and requires accepting risk. I can work with that. She asked me to recommend books and resources to help her set up her first brokerage account when she turned 18, to be available for questions as she started learning. I agreed, with the caveat that I wouldn't manage her money or tell her what to buy. You need to develop your own analysis skills. I can help you learn frameworks, but you have to make your own decisions and live with the results. The conversation made me realize I'd become someone younger family members looked to for guidance, a strange inversion of the dynamic where Raymond had been the family expert. I was careful not to replicate his condescension, to acknowledge what I didn't know as clearly as what I did. Teaching Kara the basics of financial analysis reminded me how much I'd learned over the past 8 years, how many concepts that seemed obvious now had been completely foreign when I started. The learning curve was steeper than people realized, and success required both intellectual capability and emotional resilience. About 3 years after the graduation party incident, Raymond called with an unusual request. Danny, I want to pitch you on something and I need you to listen with an open mind. Meridian is expanding and I'm looking for someone to lead our technology sector coverage. It would be a portfolio manager role, direct management of about 20 million in client assets focused on tech growth stocks. Salary would be 140,000 base plus performance fees that could double that in a good year. I think you'd be perfect for it. The offer was flattering but complicated by our family relationship and history. Raymond, I appreciate the offer, but wouldn't working together create conflicts? We've built a good relationship as uncle and nephew who talk about investing. Making it professional could mess that up. He'd clearly anticipated the objection. That's a legitimate concern. But I've watched you develop over 3 years, and I believe you're ready for this kind of responsibility. Your Vanguard experience has given you institutional discipline. Your personal investing has given you the conviction to make concentrated bets. That combination is exactly what Meridian needs for our tech strategy. And yeah, working together might be complicated, but I think we're both professional enough to navigate that. I told him I needed time to think about it, to discuss with Gregory, and consider whether leaving Vanguard made sense at this point in my career. The conversation with Gregory was illuminating. He wasn't surprised by the offer. You've been on a trajectory toward portfolio management since you arrived. The question is whether you want to do it within Vanguard's framework or somewhere with more freedom. Raymond's offer would give you direct P&L responsibility faster than you'd get it here, but it also comes with the complexity of working for family. He was characteristically thoughtful about the decision. What I'll say is this: you're ready for more responsibility than your current role provides. Whether that's at Vanguard or Meridian, you should be actively managing capital, rather than just supporting others' decisions. Your skills are wasted in pure analysis at this point. The endorsement meant a lot coming from someone who'd mentored me through institutional investing basics. I spent 2 weeks evaluating the opportunity, modeling out the financial implications, considering the career trajectory each path offered. Staying at Vanguard meant stability, continued learning within a prestigious institution, eventual portfolio management responsibilities, but on a longer timeline. Joining Meridian meant faster advancement, more autonomy, higher earning potential, but also more risk, and the complexity of working with family. I made a spreadsheet comparing the options across multiple dimensions: compensation, learning opportunities, career progression, work-life balance, risk factors. The analysis suggested Meridian offered better overall value if I could navigate the family dynamics successfully. But the emotional factors were harder to quantify, the concern about damaging a relationship that had become important to me. Finally, I called Raymond and accepted the offer with one condition. I need us to establish clear boundaries between family and professional relationships. When we're in the office, you're my boss, and I'm your employee. When we're at family gatherings, we're uncle and nephew. We don't mix the two contexts or let conflicts in one bleed into the other. Raymond agreed immediately. That's exactly right. I've thought about this too, and I think clean separation between roles is essential. In the office, I'll give you feedback and direction like any other employee. At family events, we don't talk shop. Deal? We shook on it, metaphorically over the phone, and I gave Vanguard my notice. Gregory was gracious in my exit, telling me I'd always have a home there if things didn't work out, and offering to be a reference for future opportunities. Starting at Meridian Partners felt like returning to the freedom of individual investing but with institutional resources and responsibilities. I had direct control over a $20 million portfolio focused on technology growth stocks, with the mandate to generate absolute returns rather than just track an index. The pressure was higher than at Vanguard because my performance directly impacted client returns and Meridian's reputation. But the autonomy was exhilarating. I could act on conviction, take concentrated positions in companies I believed in, manage risk through position sizing rather than committee consensus. The first 6 months were intense, building a portfolio from scratch while establishing credibility with Meridian's clients and partners. I deployed the capital gradually, identifying 12 core positions in companies I'd researched thoroughly. The portfolio emphasized emerging technology trends I believed were undervalued: cloud infrastructure, cybersecurity, renewable energy technology. By the end of year 1, my portfolio was up 29%, against a benchmark of 16%, outperforming both the index and Meridian's other strategies. Raymond and I maintained the boundary we'd established, professional in the office and familial outside it. There were moments of tension, disagreements about specific positions or risk management approaches where his experience and my conviction conflicted. But we worked through them with mutual respect, acknowledging that both perspectives had value. The working relationship actually strengthened our personal relationship rather than straining it, creating shared purpose beyond family obligation. My parents were proud, but also slightly bewildered by the trajectory my career had taken. From college graduate to Vanguard analyst to portfolio manager at a boutique fund in less than 4 years felt rapid, even to me. But each step had been logical, given my skills and the opportunities that emerged. My mother still worried about burnout, while my father had finally stopped asking whether I was sure I knew what I was doing. Kara was now in college, managing her own small investment portfolio with guidance from me, generating modest returns and learning valuable lessons from both successes and failures. The 4-year anniversary of the graduation party arrived without fanfare, just another day of managing positions and analyzing market trends. But I found myself reflecting on how much had changed since that confrontation in my parents' backyard. Raymond had transformed from the condescending uncle who dismissed my work to a professional partner I respected and learned from. My relationship with my father had deepened as he came to understand what I'd built and why I'd kept it private. My own financial situation had evolved from substantial for a recent graduate to genuinely wealthy by any standard, with a personal portfolio now exceeding $1.2 million and a professional salary with performance fees pushing $200,000 annually. But more significant than the money was the clarity about who I was and what I valued. The years of quiet investing, of building something substantial without needing external validation, had taught me that real confidence came from internal knowledge of capability rather than others' recognition. The graduation party confrontation had forced that internal knowledge to become external recognition, creating ripple effects I was still processing. Some were positive: the improved relationship with Raymond, the career opportunities that emerged, the ability to mentor Kara and others interested in investing. Some were complicated: the changed family dynamics, the expectations people now had about my financial advice, the pressure to maintain performance that validated earlier success. I'd learned that vindication was satisfying, but also burdensome in ways I hadn't anticipated. Being proven right meant people expected you to continue being right, to have answers and insights that justified their revised assessment of your capability. Sometimes I missed the anonymity of being dismissed, the freedom to work without expectations or scrutiny. But mostly, I was grateful for the journey, for the skills I'd developed, and the relationships I'd built, and the options I'd created through years of disciplined work. My personal portfolio crossed $2 million 5 years after the graduation party, compounding through continued strong returns and aggressive savings. The milestone felt meaningful, but also arbitrary. The real achievement was the process that created it, not the specific number. I was 27 years old, managing 35 million in client assets at Meridian, still actively managing my personal portfolio and trying to figure out what the next phase of my life should focus on. Raymond and I had started discussing the possibility of me becoming a partner at Meridian, taking on equity stake in the firm, and expanded leadership responsibilities. The conversations were serious and forward-looking, treating me as a peer rather than a nephew who'd gotten lucky with some stock picks. The transformation in our relationship felt like the real vindication, more meaningful than any portfolio returns. We'd moved from dismissal and condescension to genuine mutual respect and collaboration. That outcome hadn't been my goal when I'd handed Raymond my phone at the graduation party, but it was the result I valued most 5 years later. Last month, at a family gathering, someone new who'd married into the extended family asked me what I did for work. Before I could answer, Raymond jumped in. Danny's a portfolio manager at my investment firm, one of the best investors I know at identifying growth opportunities before they're obvious. You should see his track record. The casual pride in his voice, the automatic advocacy for my capability, marked how far we'd come from that day when he'd called my portfolio play money. I thanked him for the introduction, but deflected the conversation away from my returns, having learned that talking specifics about investment performance made people either skeptical or excessively interested in getting advice. The new family member asked a few polite follow-up questions and then moved on to other topics. Later, Raymond pulled me aside with a smile. I'm proud of you, Danny. Not just for the returns, though those are impressive, but for staying humble and thoughtful about success. A lot of people who achieve what you have by your age become insufferable. You've kept perspective. The compliment meant more than he probably realized. Validation that I'd navigated success in ways that preserved who I was, rather than letting it define me completely. If you made it this far, hit like. You've earned it.